You're watching Magnetic Media News Network. I'm Mia Kudos. This is Behind the Headlines. Because what matters isn't only what happened, it's what happens next. Let's begin. What happened? The Federal Reserve held US interest rates steady between 3.5% and 3.75% during its latest meeting, marking the first decision under new leadership. The Fed's rate-setting committee unanimously agreed to maintain the status quo, citing elevated uncertainty tied to geopolitical tensions, including the conflict in the Middle East and its impact on inflation. Inflation remains above the Fed's target at 3.8%, driven partly by rising energy costs linked to disruptions in global oil supply routes. The Fed's statement was notably concise, reflecting a shift in communication style aimed at reducing forward-looking guidance and focusing on immediate economic conditions. Who does it affect? This decision directly impacts borrowers, investors, and businesses across the US economy. For borrowers, steady interest rates mean no immediate increase in the cost of mortgages, car loans, or credit card debt, providing temporary relief. However, businesses planning expansions or investments may face continued uncertainty about future borrowing costs, as the Fed's projections suggest potential rate hikes later this year. Investors, particularly those in bond markets, must now recalibrate their expectations, as the removal of hints about future rate cuts could lead to volatility. Consumers, too, will feel the effects, as inflation remains a persistent challenge, eroding purchasing power and squeezing household budgets. Even global markets are not immune. Emerging economies reliant on US dollar-denominated debt may face higher repayment costs if rates rise further. What should we watch next? First, keep a close eye on the Fed's next moves. The closely watched dot plot revealed that 9 of the 18 central bankers predict a rate hike before the end of the year, signaling a potential shift in policy direction. This divergence in expectations could create market turbulence, particularly if economic data continues to surprise. Second, monitor inflation trends, especially energy prices. The recent spike in oil costs, driven by geopolitical tensions and supply disruptions, remains a critical driver of inflation. If oil prices stabilize or decline, the Fed may gain more room to maneuver. Third, watch for signals from the Fed's task forces, which are reviewing how the central bank communicates, manages its balance sheet, and uses economic data. Any changes in these areas could reshape market expectations and investor behavior in the coming months. Smart money. Neutral. Smart money is adopting a cautious stance, recognizing both the risks and opportunities in the current environment. The Fed's decision to hold rates steady reflects a delicate balancing act, addressing inflation without stifling economic growth. However, the removal of forward-looking guidance introduces uncertainty, making it harder for investors to anticipate the Fed's next steps. Smart money is closely monitoring inflation data, particularly energy and food prices, as these could force the Fed's hand sooner than expected. Additionally, geopolitical risks, such as the conflict in the Middle East and its impact on oil supply routes, remain a wildcard. If these risks escalate, inflation could surge again, prompting more aggressive rate hikes. Conversely, if tensions ease and inflation cools, the Fed may delay further action, providing relief to markets. For now, smart money is avoiding large bets, preferring to wait for clearer signals before repositioning portfolios. That is what sits behind today's headlines. Thank you for joining us for Behind the Headlines. Until next time, stay informed, stay ahead, and if you haven't already, subscribe for more intelligent analysis Monday to Friday.